Well, good morning. Well, I guess it's not morning. It's at the stroke of noon right now. So we're going to go ahead and get started with today's weekly workshop where it appears to me, but I can't tell for sure because I don't see what you see, but it looks to me like I'm kind of unfocused. So if that's the case, I apologize. I hope it won't hold true when we get to talking about some of the things that I want to share with you on today's meeting. If you watched last week's meeting, you would have had to have watched it on a recording because there was only one other person with me last week. And I will keep watching to see if anybody joins me today. But the topic of today's weekly workshop is an introduction into the series for February in which we're going to be talking about business deductions. You may recall earlier in the year, I said that the most common question that I get when working with businesses is how can I best organize my business? Now, sometimes that isn't how the question is asked, but that's what the question's about. But very definitely the second most common question that I get when working with small businesses is, what can I deduct? And there's a very short and easy answer for that. But the next 3 weeks, we will be talking about different aspects of that answer so that you get a better idea of what's going on with these deductions. If you see me fidgeting a little bit, I'm trying to stand up today because I've been sitting for so long this morning working with clients and answering questions that I felt the need to get up and move around a little bit. So, according to the tax code, a business can deduct all necessary and ordinary expenses. I said it backwards. A business can deduct all ordinary and necessary expenses for the operation of the business. Now, you've heard me talk about this before. I talked about it briefly last week, and it comes up all the time. But this is one of the reasons that it is so important to be able to maintain your activities as a business, because the number of items that you can deduct as a business owner are far in excess of the number of items that you can deduct as simply an ordinary income recipient. If you'll think about before you started your business, when you do your personal tax return, the only thing that shows up on there is perhaps mortgage interest. Medical expenses can be deducted, but only if they go over a very high threshold, both in total dollar amount and in relationship to the rest of your salary. Unreimbursed employee business expenses have not been deductible now for since 2017. What is that, 6 years, 7 years? It's quite a list of things that you cannot deduct. The last 2 years, there have been additional charitable contributions that individuals could deduct. Not additional, but there were easier ways to take them. That has gone away. And so what you're left with as an individual in almost every case is simply the ability to use the standard deduction, which is extremely high. For a married couple filing jointly, it's up around $27,000 this year. For an individual, it's $16,000 or $17,000. It's high. My point is that once that's gone, there's nothing else for you to do. But a business can deduct all ordinary and necessary expenses for the operation of the business. You can deduct all of those expenses to the point where you actually lose money. Your business income is a negative amount. And under the current tax laws, that negative amount can then be carried forward into future years to offset income that you haven't made yet. But you still don't have to pay tax on it again because the ordinary and necessary expenses of your business were sufficiently large to allow you to escape tax payments for that business income. This is a huge, huge thing. Not that I'm recommending that you operate at a loss. Quite the contrary. Our purpose for being in business is to make money, to enhance our personal wealth, to be able to do the things that we want to do, both in the business world and in our personal lives. I mean, that's why we do this. But the ability to take advantage of the inescapable costs of doing business and allow it to offset your tax costs is a huge thing. It is a recognition in our tax code of the importance of business in the nation's activities, in the nation's running, in what makes America the way it is. I was thinking and started to go down the path of talking about the fair tax and so forth, but I don't think I'm going to go there because that would open a whole other can of worms. We don't have a fair tax as that's defined in several of the bills that have been proposed. I frankly don't see it happening, at least not anytime soon, certainly not in the federal government organization that we have today. I can see some issues if you're in Indiana because of some of the talk I've heard in Indiana about reducing or at least looking at the removing the income tax. But of course, there you might have the situation where the income tax would be removed for individuals, but would still exist for businesses. So we'll have to see how that works. No, I want to talk today just about the way things are right now, certainly how they will be for the rest of this year. And my personal opinion is the way they will be for many years to come if they're ever substantially changed. So before I get into looking at some listings of specific deductions, let's unpack that word ordinary and necessary expenses. I've talked about this in the past. It's something that I talk about both in emails and when I talk to groups, and it's important for you to understand what it's about. Ordinary and necessary are two words that their common explanation is there's nothing magic packed in here. The ordinary expenses of doing a business can be seen very readily. The IRS allows you to break those ordinary expenses down based upon the kind of business that you have. Those expenses can be ordinary because everybody else in your industry does them. If you do them and they're not the ordinary expenses for your kind of business, then what you need to do is to be able to justify those expenses. And that's one of the things that I would help any of my clients to do. And I would hope that other tax professionals would do the same thing. The point is, we want to find ways to allow you to legally reduce your tax bill. Let me expand just a little bit on what ordinary can mean. And these are specific examples. I doubt they'll apply to anybody that's listening, but if they do, great. One of the, generally speaking, you can't write off your pets or the maintenance of an animal in your home or in your office unless that animal serves a purpose that is unique or specific to your business. And what I know is that you've heard the expression junkyard dogs. Well, it is in fact very common for those that maintain junkyards, open salvage yards, to have dogs that basically run loose, at least in the evening, to provide a deterrent to prowlers. They're a deterrent because the dogs are large and loud and maybe even able to do physical harm to an intruder. So if that's the case, if you operate a junkyard and you have a dog and it has vet bills and it has food bills and it needs a place to stay and you have other expenses associated with that, that is an ordinary expense for your business and for your type of business, and you'd be able to take off, deduct that money. One of the others I like to use is the idea of that the concept of ordinary can vary. We say ordinary and necessary, and not putting too much emphasis on the word necessary. Let's talk about the fact that most businesses need an office. You need a place to do what you do. That leads to such things as home office deductions, and it also leads to such things as renting a building space or a room, as I do, renting a suite here in this building that I'm in. These are things that are, because it's considered necessary for a business to have a place to operate, those kinds of expenses are usually considered. The ordinary part, however, can vary. And the example I use is this. If you have an office, you have antique walnut desks and furniture, you have tapestries, you have silk covered walls, you have walnut floors, you have original artwork on the walls. If you have an office like that and you want to take the deduction, can you? Well, let's look at it this way. If you're operating your business out of that office and you meet all the other qualifications, you probably can deduct it. But if your business is a buy here, pay here car lot for those people who have poor credit, it's a little bit harder to justify that level of expense than if you were a hedge fund manager dealing with tens of millions of dollars worth clients on an everyday basis. The poor credit risk client probably wouldn't even feel comfortable in an office decorated in the fancy style that the high value clients would consider appropriate. I mean, even myself, I look at, say, the place that Trump has down in Florida, El Lago or whatever it is. But when you see photos of it and you see the gilt columns and the elaborate decor and so forth, I don't like that. I mean, I find that pretentious and excessive. But for people of Trump's ilk at his level, that may well be what's expected. And the point is that because it's expected, that makes it ordinary in that category. But if I were to try to justify the purchase of an original Rembrandt to hang here in my office in Greenwood, I think I'd be hard pressed to be able to justify that as being ordinary and necessary. So you need to be able to pay attention to what you're doing. You do need to be able to compare what you're doing to what other businesses like yours do. What other businesses like yours do. I know I'm always talking about being a contrarian, looking for the third way, and that's an appropriate thing to do. But when it comes to justifying costs, when it comes to justifying deductions, the way that your peer businesses operate is the model that you should seek to emulate. Let's say, for example, you did want to have an original Rembrandt in your suburban small office. What kind of justification could you possibly come up with that? Well, if you had it so organized that you could consider it one of the assets that was storing the value of your business, part of the equity of your business, that might be a way to do it. However, if you were to do it that way, you would find that that actually wasn't an expense. That's a balance sheet amount. It is a transfer of assets, but it doesn't represent a reduction in income, except as the object depreciates over time. That's something else to consider. That's one of the differences between expenses and balance sheet items that you want to keep in mind. So the justification of the expense, we still haven't gotten there because that really isn't the justification of an expense like that. But let's look at some other things here in my office. I have several certificates on my walls. You can see a couple of them behind me, and there's some over on the other wall, some of the older stuff from my previous life in the insurance industry. The framing of those items was not cheap. If you've gotten a picture framed or a certificate framed like this, you know it's not uncommon to spend $100 a piece for those items. Well, that's an ordinary and necessary business expense. I've paid that expense for those items many years ago because most of them have been with me for a while. But my point is the framing of those items, it's expected for a certificate to be framed. $100 may seem like a lot of money, but I do know from doing several of them that none of these are extra elaborate. These aren't antique frames put together that have a value of their own. They're simply a utilitarian frame that makes the item look like it's supposed to look like. Make the item look like it's supposed to look like. Yeah, okay. The reason I'm going into all this detail about this definition of ordinary and necessary is that what it is the true answer to the question, what can I deduct? Because once you have an understanding of what kinds of things are ordinary and necessary for your business, then you can begin seeing more and more items that are deductible that perhaps you had never considered before. And that's the reason I wanted to talk about the theory here rather than just giving you a list. Because no matter how long that list is, there's going to be something that would be eligible to be considered as a valid deductible business expense, depending on the circumstances that it was used and the kind of business it was used in. Let's talk a little bit more about necessary. What's necessary for a business? What's necessary for a business are the things that are required to do the business. Such things as raw materials, if you're a manufacturer, processing devices, if you're a manufacturer, you know, the machinery that stamps the fenders, the lathes that turn the crankshafts, all of these kinds of things. These are all expenses, and they're treated in specific ways. Long-term items like the machinery, like my valuable artwork, are balance sheet items that are expensed off over time. The logic behind expensing things off over time is that since you get to use them for several years, it does not create a proper connection between the value and the cost of such an item to write it all off in 1 year. And we can talk about Section 179 expenses and other kinds of bonus depreciation. That's not the point. The point is that we do get to expense these items, but we generally don't expense them all off at once. But these are necessary items. In my office here, I have necessary items, although some of them have become less necessary over time. Best example is paper. I'm making a very concentrated effort this year to stop providing paper copies of the tax returns I prepare and provide electronic copies. The electronic copies are more permanent. The electronic copies are easier for both me and my clients to utilize, but there are some people who will still want to get a paper copy, or there may be some requirement for a paper copy that someone has based upon the fact that they cannot transfer the electronic document where it needs to go. So there will probably always be some paper that's necessary. So paper is an expense. It's disposable. It's something that I use. Pens, ink, writing pads, notepads, so forth. But what about a diary? What about, I've got my planner here. Is that a business expense or is that a personal expense? Well, it's a good question. As it happens, I don't write anything in that diary that isn't business related, so I've always considered it a business expense, never thought about it otherwise, never even thought about considering otherwise. But let's say, for example, let's say you have your diary and you operate two businesses. How do you expense off that diary? Do you split it between the two businesses? Do you write off in one and let the other one get the benefit? I don't know. We could talk about that. My point is, a diary for your business is a business expense, because there is a necessity that you be able to keep track of the appointments and the schedules that you have. And so that's an appropriate thing to keep track of. In addition, if you'll remember from the previous conversations about records and so forth, your diary at the business can also provide a record to help prove the nature of your business and to prove that it provides more evidence that what you're doing is a business. So that's a necessary expense, even though it's also possible that you are doing personal items with that diary. When you get into more and more items that you begin to think about the kinds of things that you must have in order to operate your business, there are some things that you might have a question about. For example, here in my office, I have a bookshelf. It's over here to my left, and it has some books on it. Some of them are books that go back to my previous life before I was in insurance, when I was a scholar. Some of them are books that I cherish because they're part of my history. I have some of the earliest editions of The Lord of the Rings in hardback that I still have. I have a book that I bought many years ago when I was a teenager called The Exploration of Mars. These kinds of things have a great deal of personal meaning, but also interspersed with these books are the U.S. Master Tax Guide for the last 5, I think, or 6 years, a variety of self-improvement books and things of that sort. So we have a mixture of books over here. Is that bookcase necessary? Well, yeah, because otherwise the books would just be in a stack on the floor. Is it a business expense? Yes, because it's full of business items. The personal items intermingled there don't really make any difference to the price of the bookcase itself. I would not write off any of the personal books as a business expense, but I would write off the individual books as a business expense. In fact, the argument could be made that some of those books, the reference books, ought to be depreciated rather than written off all at once. And it's only the trivial value of those items that makes that kind of a moot point. But it's the kind of thing that you also need to get to thinking about. So let's talk about a related issue. No, I'll save this related. The issue I want to talk about was how you can break larger items into smaller segments to itemize particular parts of an item in order to maximize the expensibility of that item. And we'll talk about that probably in our third week of what you can deduct, because that's a little more technical than where I want to go here. So what I'm trying to do is to put fresh in your mind the concept of what's ordinary and what's necessary for your business. And if you can justify any expense at all under the ordinary and necessary rules, then you can deduct it, and it will be defensible as a deduction. Now, I can't promise you in every case that you might not be overwhelmed in your argument with the IRS, because they do have the final say-so. What happens if the IRS says no and you still insist it should be deductible? Well, then it moves up to the next level of the tax realm and finally can come to a tax court case where you make your case and the IRS makes its case before the tax court, and the tax court issues an opinion. Those kinds of things are usually not done for trivial amounts or for small amounts, simply because the expense of going to tax court is substantial. I am not experienced enough yet to be able to practice before the tax court, although if I do what I do long enough and have enough experience, I could be. But a tax attorney, a licensed attorney from the get-go, can argue a case before tax court. And those kinds of arguments, then sometimes they set precedent, but certainly they always create additional evidence that can be used to justify what you're doing. And if we're talking substantial numbers of deductions that we want to preserve, then research into tax court cases, research into opinion letters from the IRS, there's a whole wealth of items that can be used to back up and justify the decisions that are made about what's deductible and what's not. And they're all based upon this concept of ordinary and necessary. And one more concept is brought in here, and it is whether or not it's a business. Is it a business? And is the expense ordinary and necessary? And if that's the way the argument goes together. So, like I said, I've spent a half an hour talking about this. I think it's an important issue, and it's one that you want to be aware of. But those are the kinds of thoughts you want to start having when you're thinking about whether or not something is deductible. And then what we're going to do is shift gears here in a couple minutes. I'm going to shift gears, and we're going to change what we're looking at and talking about. And I'm also going to shift gears and sit down. So I'm going to pause the recording, and then when we start back up again, you'll get to see what's going on with the list. Okay, we're back. I look like I'm more in focus this time. I don't know whether me standing up had something to do with that or not. But anyway, I'm sitting down now. And you can see the tax season has started because my traditional stacks are starting on their own. It's just something I can't seem to avoid, but I just wanted to let you know. I've been told by people that when I do these broadcasts, I should have a clear desk so it doesn't distract anybody. But I'm sorry, guys. This is not only the place where I record things, it's also the place that I work. And this is the way I work, surrounded by the stuff that I'm working on. And stacks just seem to grow. So please keep that in mind when you're watching this video. What I want to do is talk about some items that you might consider as a listing that you can work on. And one of the best listings I can think of comes from a tax return itself. And for those of you that file a Schedule C, you'll be very familiar with this. But this is generic. It is not detailed, but the same kinds of questions are asked on every tax return that provides a detailed listing of expenses. So that's why I'm going to share it with you today. Let me get to the right screen here. Now, I believe you should be seeing a screen that shows a Schedule C right here in the middle. I'm going to expand it so that it fills the whole screen. I don't know how to make it smaller. Well, I'm not going to worry about it. Here we are. This is a Schedule C. This is the form that you apply to your 1040 form. It's for a sole proprietorship. But remember, a sole proprietorship is a business. So what you see here on this screen is the way every business return basically looks. But basically is the important piece. There's a section for income. And there's an item here called cost of goods sold. And one of the things I want you to understand is that we add the income and we deduct the cost of goods sold. And what we're left with is what's called gross income. That's gross profit, which is income minus cost of goods sold, plus other income, which would be such things as interest from funds on deposit, maybe gasoline or fuel tax credits or refunds from state tax returns. There's a variety of things that would go in there as other income. And then finally, we're left with gross income. Gross income for the business is the amount that is the starting point. It's the top line. We will talk about cost of goods sold. We should talk about cost of goods sold right now. So let's do that very quickly. The concept of cost of goods sold is very important. While they are an expense, they are things that you pay out in order to operate the business. The kinds of rules about ordinary and necessary expenses, all that kind of thing is still there. But we put cost of goods sold into a separate category for one reason, and that is because these are costs that are directly related to the production of that income right here. If you're a manufacturer, your raw materials are a cost of goods sold. If you are an office type business like mine, the production of income that you have there comes from your knowledge. It may come from other people working for you doing accounting work or bookkeeping work in my business or whatever. The point is that the cost of goods sold, whatever it is, it needs to be something that's directly related to the production of the income that we're talking about. And there needs to be a straight line. Now, you can argue, and it could be argued, that under certain circumstances, the rent of your office space is a cost of goods sold because you wouldn't be selling what you're selling if you didn't have the office space. I don't want to get too far in the weeds on this. I just want you to understand that even though we have a separate line for cost of goods sold, that does not alter the basic equation of income less expenses equals profit. And profit is what is taxed. So that's why we have gross profit here and then add other income. And so now we have gross income. Oftentimes, particularly those of us that are fans of the profit first concept, we call this top line income. Top line profits. This is the top line. This is where we start. And then we get into expenses. And this listing of expenses on the Schedule C is a very good guide. I have oftentimes recommended that people just take a look at this guide because it gives you some idea of the easy stuff to be able to take off. It's like the top line income. This is the top line understanding of expenses. This is the stuff that you can think of without spending too much time working on it. So we start out with advertising. Every business has to pay money to do things to be able to get more business. That's advertising. One of the things that you might consider is this. If you contribute money, contribute money to a community event or perhaps sponsor a little league team, you might consider that a charitable contribution. But because of the way charitable contributions are handled, particularly when passed through entities, you're better off to be sure that that contribution comes with something in return, like having your name on the advertising, like having your name on the back of the jerseys of the team that you're sponsoring. Because what that means is that you can justify calling that expense an advertising expense and deduct it without having to do any extra steps to be sure that you get the full value of it. Car and truck expenses. There are two things that you always want to keep in mind about car and truck expenses. You can either deduct the actual amount that you spent, or you can deduct the mileage amount. Every year, the federal government issues a mileage reimbursement amount that includes all of the components of the actual expense of operating a vehicle. It includes a component for depreciation, it includes a component for wear and tear, a component for the actual cost of the fuel and so forth, the tires and the rest of it. And that's all boiled down into using some kind of big old mathematical thing. Maybe they have a auto expense actuary somewhere that figures out what that amount should be. Typically, over the last several years, with gasoline prices being where they are, it has been 55 cents a mile or more. In fact, currently it's right at 60, I want to say 62 cents a mile. What that means is that for every business mile that you drive, you can deduct 62 cents. Drive 100 miles, there's a $62 deduction that you can take. Now, the other alternative is to do the actual expenses. That means you take your, if you're leasing the car or if you're purchasing the car, your lease or car loan payments are deductible, sort of. The reason I say sort of is this. The vehicle itself is a asset. It has to be depreciated or written off as a lease because there's depreciation amounts included in the lease amounts. And so you would be able to take off that, but if it's a loan, then you can deduct the interest directly, even though you have to depreciate the value of the car. Plus which, if you buy tires or you buy fuel or you get the oil changed, you keep track of all of those expenses. You're also entitled to deduct the cost of parking and the cost of tolls if you pay tolls to drive the vehicle. Those are the kinds of things that are deducted if you use actual expenses, or you simply use the number of business miles for your mileage deduction. One thing that you all want to keep in mind is that you always have to keep track of the percentage of the use of the vehicle that is for business. Now, if you have something like an off-road truck or a dump truck that does nothing but haul dirt back and forth from the supplier to the job site, it's pretty easy to say that's 100% business use. But if you get down to a car or to a pickup truck or something smaller, you may find that it's partially personal and partially business. So how do you deal with that? Regardless of the kind of expensing that you do for an automobile, you have to keep a mileage log. And that mileage log has to include all of the miles that the vehicle was driven, and then separately recording the business miles and the personal miles. And then you use a pro rata figure to deduct the actual expenses, or you use only the business miles to deduct the business expenses. Now, the flip side of that is if the business owns the vehicle and you're the operator of it and you get to use it for business use, but you also use it for personal use, you still have to keep a log. But now, instead of deducting the business miles, you have to pay back the company for your personal use of the vehicle, unless you can justify that it's never used for personal reasons, except perhaps for trivial ones, or a trivial amount, rather. Well, how do you do this with this log? Well, like everything else, there is a shortcut that you can use. And what that shortcut is this. You keep track of the business versus personal miles for 3 months of the year. Any 3 months are good. And then once you have established the average amount of mileage division based upon that log, you can use that same percentage for the entire year. The only proviso with that is that you cannot purposefully pick months in which you will have lower mileage in order to downplay you will not have personal mileage lower. We'll talk about logs in other circumstances like this, but this is something that recognizes the fact that some things are shared between personal and business. So car and truck expenses are something that you need to keep track of. Commissions and fees that you pay out. A lot of times, let's say a real estate agent maybe real estate agent is not the best because at least in Indiana, real estate agents are all brokers, and they receive their money from the broker that they work with. But if that were the case, then the commissions and fees that are being paid would be reported here on line 10. So anything that you pay anybody that is in the nature of a commission for the work they do or a fee for the work they do, you'd report it here. Keep in mind that commissions, however, if your business is real estate, for example, then that would be a cost of goods sold, because the commissions represent money that you're paying to somebody for houses that you're selling. In other words, they're directly related to the source of the income. Then we come to line 13, depreciation, and section 179 expense deductions. These are amounts that are not included in part 3. Part 3 is on the back where the vehicle expenses are calculated, and it's where if you're using the actual cost, that information would be detailed. Let's see if we can look at the back of, look at part 3. Yeah. Other costs can show here, materials and supplies. This is where the costs of goods sold are itemized. And the thing you want to remember is, and this also illustrates something that you want to keep in mind, oftentimes there is more than one place to report the same information on a tax return. And sometimes reporting it somewhere else makes it more valuable to you than reporting it in another place. So the fact that some of the depreciation costs, particularly depreciation that relates directly to those items that are part of the source of income or the creation of the income, reported here rather than on page 1 or page 1, which is in part 2 of the expenses. Depreciation is where you report the amount that the cost of an asset, of a capital item, is eligible for expensing each year. And there are a variety of issues dealing with that. And I'm not going to spend too much more time talking about it here. That will be something we'll talk about in one of the other expense programs that we'll do in the next 2 weeks. I just wanted you to know that this is where it comes from. And then we have employee benefit programs other than those on line 19. And over line 19 tells us that that's pension and profit sharing plans. So employee benefit programs would be things like if you provide QSERA health coverage for employees, or other health coverages that employees are entitled to get, or gifts, or other kinds of things that employees receive for being employees, as opposed to pension and profit sharing plans like 401ks and other SEPs and simples and so forth. It's important that you remember that if you have employees, if they are direct employees, meaning if they are people that directly produce the item that you create your income from, that labor is a cost of goods sold. But if it's an employee that's doing other kinds of work, then their payroll would show up as an expense. I'm looking for the line for it now. Yeah, wages, line 26. But the other items that go along with being an employee, as I've mentioned, like healthcare, like a variety of different plans I can think of. It used to be a company I worked for. They provided discounted YMCA benefits. And so it was a benefit that would be paid for in part by the employer and the rest of it by the employee. This kind of information would show up there. Another big and obvious item for expenses is insurance, other than health insurance. Now, one of the things that I often argue with a client about is that if you have employees who are working in the business and producing income directly, that even their insurance for workers' compensation ought to be considered a cost of goods sold and not down here in the insurance category. But other kinds of insurance that would not come under the network or the qualification of cost of goods sold would be applied here. We also have interest that's deductible. And the reason it says it's to see instructions is because it depends upon what kind of thing the interest is being paid on as to how it's reported here. You get to deduct all of the interest. Interest is always an expense, but whether it's mortgage interest or whether it's other interest, you want to kind of separate that out because it shows more detail on the business expenses. Legal and professional services. And of course, the question is often, is accounting legal? Or is accounting professional services? Is tax preparation professional services? What about tax preparation? You know, since the 2017 tax revision, the cost of having your taxes prepared is no longer eligible for a deduction on your personal tax return. It doesn't show up anywhere on Schedule A. But if some or all of the tax preparation work done for you relates to a business tax preparation is still fully deductible and would show up here. Let's say perhaps that you have a lawyer that you pay a retainer to, or perhaps you hire a lawyer to do a specific project, or perhaps you have a membership in Legal Shield or LegalZoom or one of the other programs for that purpose. This is where that kind of stuff would show up. Office expenses, the stuff that you have in your office. It's the kind of thing that we talked about before, frames for your certificates, getting the office cleaned, paying for. Some people use this category to pay for specific office-related utilities, such as fax machines and things like that. Not the machine, but the fax line, different things of that sort. It's just everything that relates to the operation of the office that you're talking about or that you operate out of. Then we have rent or lease. And there's two kinds of things that you could rent or lease. You have vehicles, machinery, and equipment. Although I would argue that machinery and equipment specifically that is used in the production of income, the rent for such equipment ought to be included in the cost of goods sold because it keeps it directly related to income production. But there's other business property that you may pay rent for. It could be the office you occupy. It could be a storage unit at the self-store place. It could be some other item that you may pay desk rent if you share an office in an insurance brokerage. Repairs and maintenance are expenses, and they're pretty obvious and easy to see. If something's broken and needs to be fixed, then that's a business expense. And just the normal maintenance, the day to overcome the problems of wear and tear also. Then we have supplies, and that's a nice catch-all phrase. It's just the stuff that you use. And why do you not use it in Part 3? Because if it's the kinds of supplies that go directly to the production of income, then you would report it as a cost of goods sold. For example, let's say you have a manufacturing business and you buy steel rods, and those steel rods then are taken and bent or turned or otherwise manipulated and turned into the product that you sell. Those steel rods are supplies, but they're supplies that show up over here in the cost of goods sold category. Materials and supplies, line 38. But I mentioned before, let's say we're talking about white sheets of paper that you use to print out documents on. That's a supply. Likewise, the ink that you do it with. There's a variety of items, that your office needs to be supplied with You might call it an office expense, but it's also a supply. Then we have taxes and licenses. These are the kinds of things that you're eligible to deduct because they're fees that you pay to the government and taxes that you as a business owe. Now, keep in mind, wages that you pay your employees have withholding, and the taxes for the withholding portion is included in the wages that you pay. Both the FICA and the Social Security taxes are included in that, but there are other taxes that you pay based upon those wages that are strictly business expenses. They're expenses to your business. The business portion of Social Security and Medicare, the unemployment tax that's paid both at the state and the federal level for that, those are taxes that need to be paid. But there's also property taxes. There's also fees that you have to pay to maintain your license if you are in a business that has licenses. Or there are fees that you have to pay to maintain the registration with the Secretary of State. All of those kinds of things show up here in this taxes and licenses category. And once again, I would argue that the FICA amounts and the Social Security amounts that I said that the company would pay over and above what comes out of the employee's wages, I would put those in cost of goods sold, which minimizes the amount in the taxes and licenses area. Then we have travel and meals. Travel is pretty much self-explanatory, but we also have deductible meals. Why does it say deductible? Because not all meals and not the full amount of any meal is without tax deduction. But by the same token, it also has some that are ignored. And the basic rule of thumb is for 2022, all business-related meals are deductible at 50%. You get to deduct 50% of all meals. Now, the exceptions include meals that are served at an event. Say you have a convention and you have a banquet and everybody eats at the banquet. We don't cut that down by 50% because the banquet it's a different type of activity. But let's say you have a get together and everybody gets to go through the line at the cafeteria, and each person has to buy their own food, even though it's tax deductible if that's a business deduction for them. That's only deductible at 50%. Utilities pretty much go without saying. We all know what utility are: gas, electric, phone, and so forth. And then finally, we have other expenses. And if we go then back on the second page down to part 5, it says other expenses. And here we can simply list one by one the items that we are deducting, and we put their total cost here. And we total that up down here at the bottom, and we then come up here and add that number. Okay, so now we're down to those other expenses. This gives you a fairly decent but brief discussion of what you need to look at when you're doing your expenses. These are the easy ones. Now, the stuff we're going to talk about over the next 2 weeks is some of the more detailed stuff. And I just want to open this up to get your thinking started, to let you know that these kinds of deductions are worth thinking about because it can reduce your taxes in a legitimate way that gives you more money out of your business to keep and do with what you want rather than what the government wants. And I want you to think about that because of this. If you're in business to make money, and anything you do to be in business requires some commitment. It requires you to do some things. It requires you to think about some things. it requires you to be in business. And so because of that, you should not turn away, cast a blind eye on things that I'm going to talk to you about that may sound like they take a lot of effort. I've already talked about the mileage log, and we'll talk more about that later. But I've had people balk at the idea of keeping a mileage log, even though if you have a smartphone, it will be kept for you automatically. The hardest thing you have to do is choose whether that trip was business or personal. Well, this is something you want to keep in mind. If you're serious about being in business, then you need to be serious about looking for opportunities to improve the performance of that business. And by performance, I mean, well, obviously you're looking for ways to improve performance just from the deliverability or the deliverables that your business is able to do. But there's also the financial performance of your business and the idea that you need to be able to make more money out of your business. And you need to do that in ways that make sense. If you have employees, you have to do it in ways that don't harm your employees. But these are all things you need to be looking at. So what we're going to talk about the next 2 weeks are the kinds of detail that you need to consider and need to put in place to improve your business capabilities. Not capabilities, but your profits. That's what we're about in business, is making profits. So, well, I'm sorry we ran through this so quickly. It was a quick thing, but this is an item that we'll come back to over and over again. And you, as a business owner, need to spend time going over and over it again. Please consider signing up for the weekly workshop program. It's inexpensive, and it provides you not only with this information straight up, but it also provides you with a way to expand upon it, to understand it, to dig deeper into it, to make it more real, and to, because of the interaction with other people in the program, to find different viewpoints on how things are going to work. So it's worthwhile for you to do. And when you look at this, be sure to look for the link in the comments that will give you full details and allow you to sign up. But for right now, that's all for this week's weekly workshop. Thanks. See you next week.